Hello traders, welcome to the 7th module of the Advanced Technical Analysis course, Harmonic Patterns. In this lesson we're going to teach you about Fibonacci ratio and market cycles and how to draw your Fibonacci ratios and why they are important for us in this part of the Advanced Technical Analysis course. In fact, you will be using Fibonacci ratios not only to trade harmonic patterns, but you can use it in your everyday trading, just to trade a pullback and to find areas of resistance or support where you think the pullback might end, and you can trade with the trend. But I digress. Let's get started. First of all, a little bit of history about Fibonacci ratios. Leonardo Fibonacci discovered a simple series of numbers that create ratios describing the natural proportion of things. The series is derived by starting with 0 and followed by 1, then adding the first two numbers to get the third. So he added 0 and 1 and he got 1. The third number of the series is 1. Then he added the second number and third number to get the fourth number, which is 3, etc. And the series looks a lot like this: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, etc. And as you can see, it exponentially gets bigger as it goes along. Now, you might think that just having this series of numbers is not as important in trading, but the thing about this series is the ratios behind it. For example, if you measure the ratio of any number to the succeeding higher, you get 0.618. For example, if we divide 13 by 21, you get 0.618. If you divide 34 by 55, you get 0.618. And this is the golden ratio, traders. 618 is the most used ratio when you are actually trying to trade with Fibonacci's. There is another ratio that is derived and that is actually important from the series. If you measure the ratio between alternate numbers, you get 0.382. For example, if you measure 55, or if you divide 55 by 144, you get 0.382. And all the Fibonacci ratios that we are going to be using in trading are derived from this series. Now let's get to the actual Fibonacci retracement levels and extension levels. First of all, the retracement levels. Fibonacci retracement levels are ratios that we use in trading to find possible areas of support and resistance after a pullback. The ratios that we are going to be using for our harmonic trading is the 23.6, the 38.2, the 50, the 61.8, the 76.4, and the 88.6. Usually the 88.6 is a Fibonacci ratio that is not on the default settings of your Fibonacci tool, but it's super important when you are trading with or when you are trading harmonic cycles. These ratios are drawn from low to high in an up wave and from high to low in a down wave. Because these levels are possible areas where the pullback might end, in an up move you draw from low to high, and then you get the areas, the possible areas where the pullback might end and the trend might continue. And in a down move you draw from high to low because the pullback is to the upside, and we'll find these Fibonacci ratios as resistance before continuing with the down move. That is the simple way to approach Fibonacci retracement levels. Now, Fibonacci extension levels. The Fibonacci extension levels are ratios that we use in trading to find possible target areas after using the retracement levels. So basically the retracement levels are levels that you use to enter a trade, and the extension levels are levels that you use as possible targets for the wave exhaustion. And because these are entries and also exits, you can actually measure the length of a wave within a cycle. Now, the extension levels that we are going to be using is the 1, the 1.13, the 127, the 138.2, and the 161.8. Of course, there are more Fibonacci extension levels like the 224, but in this case we are not going to be using it in our harmonic pattern search. The ratios are drawn from low to high back to the retracement zone in an up wave, and from high to low and back to the retracement zone in a down wave. Now let's go to a chart so you can better understand how to draw these Fibonacci levels and how they are used. As you can see here, we have the Aussie US dollar daily chart, and we have the first up move right here. To draw the Fibonacci levels, we pick this low and this high as our low and high for the retracement levels. And as you can see here, price tested the 76.4 level to the pip and then continued to the upside. And to draw the Fibonacci extension levels, we pick this low, this high, and then we finish with this low right here, right at the retracement level, to get the Fibonacci extension 113 and the Fibonacci extension 161.8. And as you can see, had we entered here at the 76.4, we could have exited half of our position at the first extension, which is the 113, and then the last at the 161.8 Fibonacci extension. And because we are trading market cycles and because we are trading natural ratios, these tend to work fairly. These tend to be fairly accurate. The thing is that you need to use high conflicted areas in order for you to get a better entry and better exits. But this is the basic of Fibonacci trading that you need to know in order to start trading market cycles and harmonic patterns.